Welcome to the Divorce the IRS Podcast, the retirement income planning podcast designed specifically for those who want to pay the least amount of taxes possible and build a retirement income that lasts. Inspired by the best-selling book, Divorce the IRS, you get to go behind the scenes with financial planner, author, and speaker Jimmy Miller. Learn how to set yourself up to pay the least amount of taxes in retirement when you'll need your money the most. And now, here's your host, Jimmy Miller.
Welcome to episode 16 of the Divorce the IRS Podcast. Today, we discuss the seventh tax time bomb, the widow or widower's penalty. Let's dive right in. For most married couples, there's a ticking tax time bomb waiting for them in their golden years. This is a problem that most people don't like to talk about, and it's often overlooked until it's too late to do anything about it. But this issue should be discussed as part of any comprehensive financial plan, as there are ways you may be able to diffuse the problem if you act early. This tax time bomb explodes when the first spouse passes away, leaving the surviving spouse to file taxes as a single person. Often, the income doesn't decline much when the first spouse passes. It usually only decreases due to the loss of the smaller Social Security check, as all the income-producing assets owned by the couple transfer to the surviving spouse. But other things do change. The standard deduction is cut in half or more for the surviving spouse, and tax brackets jump considerably for single filers once the 2-year qualifying widow or widower penalty has expired. Paying a lot of extra tax to the IRS and having a lower standard of living once their spouse passes isn't what most people are longing for. This tragedy is often referred to as the widow's or the widower's penalty. Let's take a look at how the penalty works with an example. Let's consider a married couple, Jim and Sue, and their retirement income. Jim gets $30,000 a year from Social Security, and his wife Sue gets $20,000 a year from Social Security as well, so a combined Social Security of $50,000. Jim and Sue also withdraw $50,000 from their IRA, so that's $100,000 of total gross income. Now, while married and both living, Jim and Sue will owe taxes on 85% of their Social Security and can apply their married filing joint standard deduction towards the withdrawals from their IRA. That means $42,500 of their Social Security, $50,000 in total, is the taxable portion of their Social Security. $3,300 is all they have left to pay taxes on as the taxable portion of their IRA after they apply their standard deduction, which is $36,700 for a married couple, both over 65 years old in 2026, and then including the over 65 deduction and the new over 65 deduction that was passed as part of the One Big Beautiful Bill Act. So all in total, they have $45,800 left of the $100,000 of total income that's taxable to them in 2026. Now, Jim and Sue are in the 12% marginal tax bracket, and they pay an effective rate of 10.9%. They owe exactly $5,000 in federal tax, and their take-home spendable income is $95,000. Now let's take a look at what would happen if Jim were to pass away. Sue would lose her $20,000 Social Security check because it's the smaller of the two, and she would inherit the $30,000 check that her husband Jim was getting, the larger of the two checks. So $30,000 is Sue's new Social Security amount. She still wants to take $50,000 from the IRA. So her total income now is $80,000. Their income only dropped by 20% or $20,000 from $100,000 total to $80,000 total. So Sue is going to have less income than she did when she was married. Now, despite being widowed, 85% of Sue's Social Security is taxable to her. So her taxable income would look like this. She would now have $25,500 as the taxable portion of her Social Security, which is 85% of her benefit. Out of the $50,000 she takes out of the IRA, $31,850 would be the taxable portion after applying her standard deduction, which has been cut in half now that she's single and over age 65. Sue would actually lose the extra $6,000 in standard deduction that was enacted by the One Big Beautiful Bill Act because her single income is now over the limit of $75,000 to qualify for the extra $6,000 in standard deduction. So Sue has lost a lot of standard deduction, and now she's in the single tax brackets as well. Thus, she would have a total of the $80,000, $57,350 would be her taxable income. Now, Sue by herself would be in the 22% marginal tax bracket, and she would have an effective rate of 12.8%. She would owe $7,329 in federal tax, which is $2,329 more than when she was married, even though her income went down by $20,000. And her take-home income would become $72,671. So even though her income is considerably less due to the loss of $20,000 a year from the lost Social Security, Sue pays more tax than when she was married. She jumps up in the marginal tax brackets by 10%, and her effective rate jumps by 1.9%. This certainly isn't the news Sue wants or needs to hear the second year after her husband passes away. Now, you can diffuse this bomb with two approaches. Let's take a look at each one. Had Jim and Sue planned for a tax-free retirement, they would be withdrawing their $50,000 each year from a Roth IRA instead of a traditional IRA. This one change would have moved them from paying taxes in retirement to a 0% tax bracket without any taxes in retirement. Their take-home income together would have been the full $100,000 per year. And once Jim passed, Sue would have still received all of the income, which is $80,000 a year, with $0 in taxes owed to the IRS. Now, imagine if tax rates increased from here, as is likely. That would make this painful situation even more difficult for Sue, which is really sad. And if you're in a state where you have to factor in state income taxes as well, that hurts even more. If you're married, this could be a ticking tax time bomb waiting for you in your retirement. It should be discussed and specifically planned for. If you haven't addressed this issue within your retirement plan, please do so as soon as possible. This is another tax time bomb that can be diffused by utilizing tax-free bucket accounts. Withdrawing your income from Roth or other tax-free accounts has no impact on your taxes and won't allow the new single tax brackets or lost tax deductions to your spouse affect you once your spouse passes. You can even take more money out of the Roth IRA to make up for the lost Social Security income without it increasing or affecting your tax bill at all. The Roth IRA is not the only approach that can be used to diffuse some of these tax time bombs. Another approach is to use life insurance. Some couples purchase a permanent life insurance policy that will pay out when the first spouse passes. The proceeds from life insurance are received by the surviving spouse tax-free and can be used to offset the widow or widower's penalty simply by providing more money to pay the increased tax bills. Now, calculating the correct amount of life insurance to purchase for this strategy can be tricky. This is because it depends on unknowable factors, like at what age each person will pass. But reasonable assumptions can be made, and with the help of some planning software and a good financial planner, it's possible to figure out a prudent amount of insurance needed to diffuse this tax problem. Although it may be uncomfortable for married couples to discuss what happens after one of them passes, the widow or widower's penalty means it's important to plan for this tax time bomb. With two approaches available, Roth IRAs and life insurance, it's possible to diffuse this problem, even with the unknowns involved. Unfortunately, though, as we will discover next, it's not just the surviving spouse who pays tax. Once both spouses have passed, there are taxes from the grave for the kids to deal with. Stay tuned to the next episode where we will discuss this final tax time bomb, paying taxes from the grave. You will learn why your kids will likely have to pay even more taxes on the money they inherit than you paid while you were still alive.
Want even more ideas, tools, and resources on how to navigate your financial life? Check out all the resources on the Divorce the IRS website at divorce-the-irs.com or the Baobab Wealth website at baobabwealth.com, and subscribe to the blog to stay up to date on issues affecting retirement income planning. Don't forget to subscribe to the podcast so you never miss an episode. Baobab Wealth and Baobab Wealth Abroad are DBAs of Baobab Wealth LLC, a Florida-registered investment advisor. This podcast is designed for general education purposes only and shouldn't be taken as legal, investment, or tax advice. You should seek out a qualified tax professional or licensed financial advisor to determine what is best for your personal situation.